the silent giant, unveiling the immense power of compounding. In the realm of finance and investment, few concepts possess the understated yet potent force of compounding. Often described as interest earning interest, it's a process that, over time, can transform modest sums into substantial wealth. While it might seem simple on the surface, understanding and harnessing the power of compounding is crucial for anyone seeking long-term financial security and prosperity. Compounding, at its core, is the exponential growth of an asset. It works by reinvesting the earnings generated from an investment, whether it be interest, dividends, or capital gains. These reinvested earnings then generate their own earnings, leading to a snowball effect that accelerates the growth of the principal investment. This is where the magic happens. It's not just the initial investment that's growing, but also the accumulated earnings. One of the most famous proponents of compounding understood its power intimately. As Albert Einstein reportedly said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." This quote encapsulates the essence of compounding. Those who grasp its principles can leverage it to their advantage, while those who remain ignorant of its workings may unknowingly miss out on significant opportunities. The mechanics of compounding, a closer look. To illustrate the power of compounding, consider this hypothetical scenario. You invest $1,000 in an account that earns an annual interest rate of 7%. With simple interest, you would earn $70 each year, resulting in a total of $1,700 after 10 years. However, with compounding, the interest earned each year is added back to the principal, and the next year's interest is calculated on the new, larger balance. This means that in the second year, you're earning interest not just on the initial $1,000, but also on the $70 you earned in the first year. This continues year after year, resulting in a significantly larger sum over time. After 10 years, your initial $1,000 investment would grow to approximately $1,967.15. While the difference might seem negligible over a short period, the true power of compounding becomes evident over longer time horizons. After 30 years, that same $1,000 investment, earning 7% annually compounded, would grow to approximately $7,612.26. This highlights the critical role time plays in unlocking the potential of compounding. Factors influencing the power of compounding. Several factors influence the effectiveness of compounding. Interest rate, rate of return. A higher interest rate or rate of return will significantly accelerate the compounding process. Even a small increase in the rate of return can lead to substantial gains over the long term. Time horizon. As demonstrated above, the longer the investment period, the greater the impact of compounding. Giving your money ample time to grow is paramount. Principal investment. While compounding works its magic, regardless of the initial investment size, a larger principal investment will naturally result in a larger final sum. Frequency of compounding. The more frequently interest is compounded, for example, daily, monthly, quarterly, the faster your investment will grow. While the difference may be marginal, it still contributes to the overall compounding effect. Leveraging compounding in your financial life. Understanding the power of compounding is just the first step. The next is to actively leverage it in your financial life. Here are a few ways to do so. Start early. The earlier you begin investing, the more time your money has to grow through compounding. Even small amounts invested early can make a significant difference down the line. Reinvest earnings. Always reinvest any dividends, interest, or capital gains earned from your investments. Avoid spending these earnings, as they are crucial for fueling the compounding effect. Choose investments wisely. Select investments that offer a reasonable rate of return and align with your risk tolerance. Consider a diversified portfolio of stocks, bonds, and other assets to potentially maximize returns while managing risk. Stay consistent. Avoid withdrawing funds prematurely, as this can interrupt the compounding process. Regular contributions, even small ones, can further enhance the power of compounding. Compounding is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. However, for those who understand its principles and harness its power, it can be a powerful tool for achieving financial goals, building wealth, and securing a brighter future. By starting early, reinvesting earnings, and staying consistent, you can unlock the silent giant of compounding and watch your investments grow exponentially over time. It's a testament to the fact that sometimes the most effective strategies are the ones that operate quietly, diligently, and powerfully behind the scenes.